Understanding the WACC is essential if you want to ace an investment banking interview. Now, in part one, we tackled the weighted average part. In part two, we tackled the cost of equity, and today is the cost of debt. So we're trying to find out how much it costs our company to borrow debt in the market today. However, because interest is tax deductible, the effective cost of debt for a company is the cost of debt times 1 minus the tax rate. Therefore, we both need to know what is the cost of borrowing today, as well as their marginal tax rate. So let's actually tackle that tax part first. When a company borrows debt and pays interest, that interest is tax deductible. Just like interest you'd pay on a mortgage, where it lowers your taxable income, or a student loan, it does that for companies as well. We need to find out the marginal tax rate. In the US, the federal corporate tax rate is 21%. However, there are also state and local taxes. So we typically have to tack on another 1 to 5%, and a typical assumption for the US corporate tax rate is about 25%. If you were valuing a business that was based in another country, you'd want to look at that other country's corporate tax rate. Next, we need to find the interest rate that a company would have to pay if they raise money in the market today. The easiest way to do this for a public company is to find out what is the yield to maturity on one of their long-term bonds. Now, you can't just look at the coupon on their existing debt because market rates move around. So a bond issued in 2020, for example, would have a much lower coupon than a bond that was issued today. The yield on that 2020 bond reflects the movement of market rates because investors are willing to pay less for a bond that has a lower coupon. So the yield to maturity will reflect that. A 3% coupon bond might now trade with a yield to maturity of 7%. So we want to look at what is that yield to maturity. Check out the caption for what you would do for a company that doesn't have liquid debt. And then finally, let's actually throw some numbers out there. So if the cost to borrow money today is 7% and the tax rate is 25%, our cost of borrowing would be 5.25. This goes into the WACC calculation because that 5.25 would get multiplied by the percentage of the business that is funded with debt, which would then get added to the cost of equity, which in our prior video was 11.25. So we'd multiply that by the percentage of the business that is equity funded. Boom, 3 videos later, we have our discount rate. Just so that if you're in investment banking, your MD can say, you know what, that rate looks a little high. Let's just use what equity research says. I kid, but it's true.